Oil prices in flux, the tensions ahead of the Trump-Putin meeting, in a developing situation that has serious implications for global oil markets. The prices of oil are seeing a decline as a result of heightened political tensions. With Presidents Trump and Putin scheduled to meet later this week, uncertainty looms large. Adding to this complexity, Trump missed his own deadline for implementing stricter sanctions against Russia, which had been contingent on Russia's commitment to negotiate a peace deal with Ukraine. This failure to impose new sanctions is a likely factor behind the recent dip in crude oil prices, with Brent crude trading at levels not witnessed since early June. The focus now turns to the upcoming meeting between Trump and Putin this Friday, where many stakeholders hope a constructive dialogue could lead to progress in peace negotiations. However, given that Russia is insisting that Ukraine must relinquish control of certain territories as part of any resolution, a rapid agreement appears improbable. Ukraine is understandably hesitant to concede its own land, which complicates the prospect of a peaceful settlement. If there were to be any movement towards de-escalation, it could result in reducing the sanctions risk for the oil market, likely pushing prices down even further due to the overall bearish trends. Recent data on market positioning reveals that speculation in the oil sector is predominantly pessimistic, despite ongoing concerns about sanctions and potential tariffs. Last week, traders cut their net long positions in ICE Brent crude by 20,375 lots, bringing the total down to 240,977 lots as of Tuesday. This significant adjustment appears to be driven mainly by long positions being liquidated. Additionally, expectations surrounding ICE gas oil weren't any brighter, as speculators decreased their net long positions there as well, with a reduction of 14,637 lots, bringing it to 86,007 lots. The ICE gasoil market has been facing some downward pressure, evident in both crack spreads and time spreads trending lower. On another note, last week marked the first increase in the U.S. oil rig count since April. According to data from Baker Hughes, which reported an uptick of 1 rig, raising the total to 411. This bounce back in rig activity comes after a lengthy period of decline, fueled by decreasing prices and a generally negative market outlook. However, recent price stabilization seems to have provided some reprieve, mitigating the downward trajectory of rig count declines. Metals: uncertainty looms over U.S. tariffs on gold imports. In the metals market, significant price fluctuations have occurred following revelations regarding tariffs on gold imports from the U.S. On Friday, gold futures on the New York market jumped after the Financial Times reported that the import of 1 kilo bullion bars, widely regarded as a standard trade unit, now falls under U.S. levies, contrary to previous assumptions that gold would escape such tariffs. Since these gold bars account for a major portion of Switzerland's gold exports to the U.S., this news caused a notable spike in the price differential between New York futures and London spot prices, reaching the largest premium seen since the onset of the COVID-19 pandemic. At one point, contracts for December delivery soared more than $100 above global standards. However, this situation has since calmed somewhat, as new reports suggest that the White House is set to clarify the policy with an executive order, potentially indicating that tariffs may not apply to imports of gold bars after all. Agriculture, grain export challenges for Ukraine. Turning to the agricultural sector, it appears that Ukrainian grain exports are significantly lagging due to ongoing conflict. Recent data from the Ukrainian Agriculture Ministry highlights a sharp 55% decline in grain exports for the 2025-26 season, totaling merely 2.1 million tons as of August 8. This sharp decrease includes corn exports falling 62% year-on-year, now at 706,000 tons, with wheat exports also down by 49%, totaling 1 million tons. While this challenging backdrop continues, Ukrainian farmers have managed to harvest 20 million tons of grains and legumes this year, falling short of the 27.3 million tons harvested during the same timeframe last year. In contrasting figures, the Institute for Agricultural Market Studies, ICAR, indicates an increase in Russia's soft wheat production estimates for the 2025 harvest, expected to reach 84.5 million tons, up from a previous forecast of 84 million tons, driven by unexpectedly favorable yields in the Central and Volga regions. Furthermore, ICAR has revised its export predictions upward by 0.5 million tons to 41.5 million tons for the upcoming 2025-26 season. Moreover, data from the CFTC reveals that money managers have adopted a more bearish stance, increasing their net short position in CBOT wheat by 15,445 lots, culminating in a total of 80,769 lots as of August 5. Likewise, there has been a corresponding increase in bearish sentiment toward CBOT soybeans, where speculators boosted their net short position by 29,619 lots to a total of 65,930 lots, the most negative positioning seen since December 2024. Engage with us. What are your thoughts on the shifting dynamics in the oil market, and do you think the upcoming Trump-Putin meeting will lead to meaningful changes or simply more uncertainty? Let us know in the comments below. Disclaimer: this publication has been created by ING solely for informational purposes and does not take into account any individual's financial situation or investment goals. The information herein should not be viewed as investment advice, nor does it constitute a solicitation to buy or sell any financial instruments. For more details, please read our content disclaimer. https://think.ing/about-content-disclaimer